All right, man. Hey, I just figured it'd be easier to type a little video for you on this. I'm sorry, what was your name? Why is it in developer mode? Okay, hey, Yeti Claus, what up? Um, okay, so, a couple things on this. We're going to be looking at these two candles, the previous day and the current day that I ended up buying. And this is a classic oops reversal. So these are the steps to an oops reversal. I know it probably looks intimidating, oops, but it's really quite simple. And I just want to kind of walk through them. Let me just make this. Kind of each step and why it is reasonable to take a full size trade. Okay. So I'm going to move these arrows away. First, we opened up red on the day, right? Slight gap down. We broke previous day's low. So I'm going to mark out previous day's low and low of day, right? We don't know where low of day is, but if you look here on the hourly, right, pretty quickly in the session, at some point, whatever, 30 minutes in, an hour in, we established a low and we started working our way back up. Okay. So that's the first step. So we've got a potential oops reversal on a stock that is leading in the optics group, is pulling back into the 20 MA, and we're interested in it, right? So you don't just want to be taking this randomly. It's a stock that we're interested in buying, right? It's a pullback and a higher low off of this earnings gap down, big red to green move. So the first trigger on this, so this is if you look at these first two columns of the oops reversal, these are the start of it. And then each of these steps is essentially a trigger for the stock, right? You could enter at any of these places down here. These 5 spots are actionable spots on an oops reversal. So if you come back here on the hourly, right, let's break this down minute by minute, essentially. So your nasty red candle open, looks like it might be breaking down, whatever. All of a sudden, buyers step in and we start pushing, okay? Then we reclaim previous day's low at 211. We just mark that out, 211. That's our first trigger at 211. Next step on this hourly is we reclaim the opening range high, right? The current high of day. We make a new high of day on Tuesday the 17th at 10:30 in the morning. Then we break the opening range high. That's another trigger. So you could have bought this at 211, at 212.75 with the low of day stop, risking $8. Okay, that's reasonable. The next trigger on this is previous day low, boom, we reclaimed it. Break current day's open. Boom, we reclaimed it. Go red to green. There's our red to green spot. That's the previous day's close, 217.20. There's another trigger at 217.20. Next step on this is to reclaim 50% of the previous candle. So if we just do, you can use a Fibonacci retracement or whatever to find 50%, but it was $12.38. So $6.19. So 217.19 is the 50%. Once we go red to green, we're already at 50%. So that's triggered and engulfing on this, which is pretty common on oops reversals for them to engulf. Right? Which engulf just means break that previous day high because we already made a low and then now we're looking to go make a new high. Okay. So I bought this at 219. I'm sitting here watching this hourly, watching it kind of consolidate, flipping between the 30-minute here on this day as it consolidates. And this is the 30-minute candle that I bought on right here. Around, I'd have to go back and check my alerts, but let's just say it's around this 12 to 1 o'clock time frame on the East Coast. So what we retested that 50% retrace. We retested the red to green spot, which makes it especially strong. Okay, so what my thinking was that we were going to go engulf the previous day's high up at about 224. Okay, is what my expectation was, my thesis, my hypothetical, my most likely scenario in the most ideal world. So I'm like, okay, 217 would have been ideal entry, 212 would have been an ideal entry, 211 would have been an ideal entry. Any of those spots really in that zone is a good spot. Even if it pulls back in and you're like looking at a 5-minute, 15-minute, 30-minute, whatever, and it holds in that area, so you can really just shade this in green and look for some sort of 15-minute hammer candle, 30-minute hammer candle, hourly hammer candle, just some sort of presence of buyers to risk off of if you don't want to risk to low of day. Low of day is very, very simple, but I really wanted this stock. And I really didn't want to risk like 10% on it, right? 219 with a 204 stop, that's $15 on a $200 stock. You're looking at 7.5% roughly of risk, 7.8% of risk. And I'm like, let's find a way to not risk 7.8% so I can get, a 15, 20% position on this and, be a little bit more comfortable in it. So I was just going to enter and be willing to watch it behave. And I don't just mean not have a stop, but be willing to watch it behave into the end of the day. And it did, right? It got up to 225, so I'm up $5 on it, into towards the end of the session. I'm like, okay, perfect. Next day, we push up to 229. I'm like, okay, cool. 230. I'm like, okay, I'm up $11 on this. Don't exactly have a stop, but I know how this should act and should behave. So I'm just going to monitor closely and kind of see what occurs if it closes above the 9 EMA, if it undercuts the 20, whatever. Okay. And then what happened the next day is when the trade really kind of got defined. So I'm going to remove some of these lines and just put this hourly on my chart of where I got in, 219.50, and then that 217 zone, okay, which was the red to green move. Somewhere in this area, I'm like, okay, really prove to me that my stop can be in here, and let's just go take a look at it. Stock this morning on Thursday, right, when it really ignited, which you could have bought again that day because you undercut previous day low and quickly reclaimed. That's a presence of buyers area to risk of, right? So that gave us, another clean, clear signal. And I sent it out on my channel. Actually, really am happy the way that I walked through this trade. And that gave us a clear risk area. So now we've got our entire risk defined on this trade right here in this zone between 219.50 and 216.50 on this. And we go again and break, the current day's open. We go break previous day and the stock just takes off. Okay. So my risk was somewhat ambiguous during this period. I would have done a mental stop of 3%, of 3.5%. And that's really the way that I approached it. Wasn't a, low a day stop. It wasn't a, hourly certain area stop. It had some elements of that. But it was really, okay, let's see if I can give this 3%, 3.5% on this trade. So I can take a bigger size, a normal size, right? A reasonable size that's really going to move my account, upwards of 20% at least. 15 to 20% is what I prefer to take of my account. Sometimes, closer to 30. Anyways, and it's a little bit aggressive, but I'm also really good at managing risk and taking 1% losses, 2% losses, rarely 3% losses, to be honest, and go with it. So all of a sudden my risk was just purely defined at $3, roughly 1.5%. I'm like, okay, really, I should have added to this. I should have added a lot to it. So I was sitting at about 20% of my account in this at this point, a little bit less. It's actually closer to 15, sorry. Once we took out this hourly high right here, so I'm looking at this candle, I really should have added more that next day. And even more, once we built this little hourly flag and broke out further, I should have added again. Okay. I should have been willing to really pound into this trade, given the way that it was structured, given the way that it was built out, given the group and the way the market was acting, quite frankly. And let's look how this played out. So I should have been willing to add at each of these hourly candles right here into strength. I'm going to take this one away. I should have added all those. I should have bought here. I should have bought right around here. And then added these 3 spots. That's how this trade should have been done, which was like buy 100 shares, buy 100 shares, buy 100 shares, buy 100 shares, buy 100 shares. Right now you're sitting in a really, really nice position with clear defined risk. My average would have been, let's just say if you did 100 at each of these spots, 500 shares would have been, probably $219.50, right around my average. So I'd be risking $3, less than $3, $2.60 on 500 shares. You're risking, $1,400 That's really not that much. In the, depending on account size, right? You can move those numbers to 50 shares or to 5,000 shares, right? Or to 10 shares, whatever fits your account. But that's tight fucking risk. And then look what the stock does, right? It turns out to go up, over the course of the next, 4 or 5 days, up, 25%, right? 25% gain on 1.5% risk is substantial. That is substantial. You can move your account. You can take another 20 losses, a little bit less than that, but let's just say 15 losses in a row. 1 loss, 2 loss, 3 loss, 4, 15 in a row after this trade, and you would be at break even, right? So I could take this trade, sell it, get my 25%, risking 1.5%, appropriate sizing, go on for 15 trades in a row and lose, 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 lose. And I'm back where I was this day. That's how risk to reward works. That's how position sizing works. And that's how account management works. And statistics and the math of trading is phenomenal. And it has to be applied to really simple quality setups on really strong stocks that move in good groups. So again, to put it simply, I hope you're still watching. Big move, pull back to the 20 MA, oops reversal, just undercut previous day low and reclaim. And that's your entry. Stop low a day. I did a little bit of a makeshift stop, 3.5%, 3%, and monitored it till my stop was purely defined by the stock. Okay? Hope that helps. Bye.